This is PHELAN Myers, 2 for 20 with the PHELAN Myers Wealth Management Group of Janney, Montgomery, Scott. Janney, a member of FINRA, SIPC, and the New York Stock Exchange, maintains a presence in Duluth with their office at 6340 Sugarloaf Parkway, Suite 130 in Duluth, Georgia.
Greetings and salutations, everybody. It's Stephen Julian, your trusty co-host here for PHELAN Myers 2 for 20. PHELAN Myers 2 for 20 is brought to you by the PHELAN Myers Wealth Management Group of Janney, Montgomery, Scott. I'm pleased to welcome in the host of the show, Scott PHELAN. Scott, welcome to your own program.
Well, thank you. I appreciate it, Stephen.
Absolutely. You've got a great guest, so I'm just going to let you introduce your guest today.
Yes. You know, one of the things that we talked about last show that we'd done was to have a different financial topic once a month. And so we thought it'd be timely to have a CPA come in and talk about some year-end tax planning, kind of what we see maybe for 2022 with some of the potential tax changes coming down the line. So we have Cliff Bray today. He is a local CPA that I've known for a long time, does a really good job. So Cliff, you mind just telling us a little bit about yourself and how long you've been in practice, where you're located, that type of thing?
So I'm located in Duluth over by the Gwinnett Arena. Our firm's WMBO CPA group. We've been around since 1988. I've been in practice for 26 years now.
Perfect. So why don't we jump right into it? So let's talk about, if it's okay with you, Cliff, just some year-end tax planning things that we see. So one of the things in my practice that we do a lot of, and hopefully it's not too much because, you know, hopefully we have gains across the board for the year. But if you have a stock or two or something like that you have a loss in, maybe some tax loss harvesting going into year-end, do you see a lot of folks trying to do that this time of year?
We do. One of the things that we do with year-end planning is try to, if a client has significant gains, we get with the brokers to say, hey, any stocks that got losses here that we can harvest to help reduce those gains so that even eliminate some of those gains and maybe create a deduction for you where we can take the limited $3,000 capital gain loss for folks.
Okay. So do you mind just explaining a little bit to the audience how the losses work against gains? So, you know, if let's say I sell a stock and I've got a $50,000 gain. I sell some Home Depot and I have a $50,000 gain. If I can take losses elsewhere, how does that work to offset that gain?
You sell the Home Depot for $50,000. Well, let's say Lowe's has a $60,000 loss. Well, we sell the $60,000 and we got a net $10,000 loss there. Well, for tax purposes, we're only limited to deduct $3,000, but that extra $7,000 loss there, we get to carry it forward into the next tax year and use that to offset any gains that year or take additional loss.
Conversely, if you sell that Lowe's and let's say it's not $60,000, let's say it's just less than the 50, it's $25,000. Does that mean you've reduced the gain overall by $25,000?
Exactly.
Okay. So let me take from tax loss harvesting and let me ask another thing for year-end tax planning is a lot of people have 401k plans or some kind of retirement plan or just IRA accounts. What are the ways that you want them to kind of do some stuff year-end to make sure and help with their taxes?
Well, what we want them to do is if they're participating in their company's retirement plans is to maximize the deductions there. So like with 401ks, you can defer up to $19,500 for the 2021 tax year. If you have a simple IRA with your company plan, that's $13,500. But if you're over 50, you also have what's known as a catch-up. You can do an additional $6,500 with the 401k. So you've got a total of $26,500 there that you can defer and reduces your taxable income. And with your simple IRA, you've got another $13,000 if you're over 50 that you can defer, so a total of $16,500 deferred taxable income that will reduce your taxable taxes.
So going into year end as an example, if let's say I've got, and I'm just under 50, I'm getting real close to 50 actually. So my maximum I could do is 19.5, right? Maybe I've deferred 10,000 so far this year. So what you're saying, I think, is going into year end, I could defer a much more significant part of my paycheck, maybe than I'd done up to that point, to get to that 19.5 or get closer to that 19.5.
That's correct.
So maybe I defer 50% of my income between now and year end to max it out.
That's correct.
Where in the past maybe I was deferring 5, something like. Okay.
Or even let's say that you don't have enough we're short on time to the end of the year and trying to maximize that, you can always write a check to your employer and have them add that to your 401k withholding.
Wow.
Is that right? I did
Little
not.
topic. Nice.
I did not realize that.
Something that even the advisor needs to learn.
I
there at the end.
did
That's
not
a good
know
one.
that. I did not know that.
Let me ask this question, because retirement plans and IRA, when you were talking about the retirement plan and the 401k, you talked about salary deferral.
Mm-hmm.
Is the IRA contribution a salary deferral as well?
It is not.
Okay.
So an IRA contribution is a direct deduction against your taxable income on your tax return.
So it still helps, but not as much as deferring salary.
Not as much, but if you don't have the opportunity to defer income through a retirement plan with a company, you can do an IRA, and for 2021, that's $6,000. Or if you're over 50, you can add another $1,000 to that for a total of $7,000 of a deduction.
A lot of time, this time of year, you'll see folks doing charitable giving. So do you mind talking a little bit about how that works? And then do you normally recommend giving, for example, a highly appreciated stock or writing a check to charity?
So in talking about the stock, we always recommend doing gifting the highly appreciated stock. Because if you give that, then you're giving the fair market value of that stock. So let's say that, going to the Home Depot example of the selling for capital gains, let's say it's $50,000, it's worth $50,000. If you give that stock of $50,000, that's your charitable deduction.
Mm-hmm.
But let's say instead of you go to give the cash of $50,000 and you sell that stock and you have a $25,000 basis in it, so you have $25,000 of gain. Well, if you give the $50,000 of cash, now you got to pay tax on that $25,000 of gain that you just realized. So we always recommend give the stock, avoid the capital gain in those scenarios.
So in that example, give the $50,000 of stock. Charities don't pay any taxes because they're tax-exempt organizations. You get the same $50,000 deduction that you would get if you gave cash. And you could turn around and buy $50,000 worth of Home Depot with the check that you were going to give to charity, and now you have a $50,000 basis in that Home Depot versus a $25,000 basis.
Correct.
I got you.
Scott's getting very excited about this strategy. I think he's going to talk to some of his clients. Let me ask this: and as far as gifting to charity, what about gifting to individuals? What are some of the tax benefits to gifting to individuals?
Gifting to individuals is it's not a tax deduction to itself, but what that does is that allows you to move money out of your taxable estate if you have one.
Okay, so it's not a deduction, but it reduces your estate. Okay.
Right, so it reduces your estate, and your limit for 2021 is $14,500 per individual, whereas a married filing joint couple is $14,500, so $29,000 total to one particular individual for a husband and spouse.
Okay. We've been talking about year-end tax planning basics. Before we get to the next topic, let me just ask something a little bit. Let me just let you impress us with something maybe a little bit less known, because I think a lot of people know some of the things we've been talking about. You've impressed us with the year-end write your check to the company. I like that one. Anything else as far as a credit or anything for year-end tax planning that people would go, what? Never heard of that.
So let's say for 2021, if you are over age 72, have to take your required minimum distribution out of your IRA. Well, there are still rules in place that allow you to make a contribution to a charitable organization of your required minimum distribution that satisfies those rules for the RMDs, but is not subject to tax on your personal tax return. So there's an option for somebody that has to take their required minimum distribution out of their retirement accounts, and then you're not paying tax on it, and you're getting the benefit.
So just to clarify, so if my required distribution is $25,000 as an example, and I'm 74 years old, I could give some or all of that to charity, and it would keep that off my tax return.
That's correct.
Right. Okay, I got you. So one thing that I hear folks talk about from time to time are movie credits. And, there's lots of movies that are filmed in the state of Georgia. Can you just kind of explain how that works in terms of, what the tax benefit is, why movie credits are available in the state?
So the state legislature, to help promote filming in the state of Georgia, instituted tax credits that the movie companies could generate from their revenues. And they also made those movie credits transferable to individuals. So through a credit broker, you can acquire these credits, and they are a dollar for dollar against your taxes. So let's say that your taxes, Georgia state tax is $20,000. You can go to a credit broker and buy $20,000 worth of tax credits. Well, the benefit to that is that the brokers will sell those credits to you from anywhere from 89 cents to 92 cents on the dollar. So you can be saving anywhere from 8 to 11% against your state taxes.
So in that example, if your state of Georgia income tax is $20,000, basically you could pay it for, to keep the math easy, let's say 90 cents on the dollar, you could pay your state of Georgia $20,000 tax liability for $18,000. Is that
correct?
Gotcha.
I like that. So, Cliff, you've been helping our listeners save money, helping our listeners prepare for the end of the year. I think we've put it off as long as we can, Scott. I think we have to start talking about new tax stuff for 2022.
And there's a lot of conversation about that.
There's a lot going on.
We tried to hold it off as long as we could, but we have to get into it. So there's a lot. So, Scott, where do you want to start?
Yeah, why don't we start with what potentially is going to happen next year? I mean, I'm hearing things about the estate tax exemptions going down, income tax rates going up, capital gains rates potentially going up. I mean, can you get maybe into a little more detail on each of those?
Sure.
And then what have you heard is probably going to end up happening? I mean, will there be some type of an agreement that's come to between the Democrats and Republicans where instead of going to a top rate of 39.6, maybe it's 37%?
So what I've heard so far, and we'll start with the estate and gift tax, is that so for 2020 and for 2021, the maximum gift tax exclusion is $11,700,000. Under the current proposed tax laws, that for 2022, that's going to drop down to $5 million. So if you have a taxable estate at this point in time above the 11 million, you want to go ahead, get with your advisor, get with your attorney, your estate attorney that's helped draft up your wills, and take a look at what do I need to be gifting now to take advantage of this $11,700. Because if the tax law is passed and it drops to $5 million, you're out of luck at that point in time. You can take advantage of it now before the end of the year and reap those maximum exclusions with no problem whatsoever.
So the $11.7 million that you reference is a lot of time referred to as the unified credit. Unified in the sense that either you can give it during life or at death. And so I think what I hear you saying is if that 11.7 goes to 5 million, the way that they're proposing, you have the ability now to use some of that 6.7 million that you're potentially going to lose in the form of go ahead and gifting some to your beneficiaries, kids, grandkids, whomever it might be.
Correct.
Okay, I got you.
And just as important, that needs to be done before the law actually
Changes.
Happens.
Yes.
Because afterward, you're kind of out of luck unless there's another administration later that changes it back, yada, yada, yada.
And I think the other takeaway would be if you are married and have a net worth that exceeds $10 million, if you're single and have a net worth that exceeds $5 million, and this law actually goes into effect probably at some point in 2022 or shortly thereafter, you want to get with your estate attorney and talk about how can we mitigate some of these taxes.
That's very correct.
Yep.
All right, so let's talk about the tax rate. I believe it's being proposed at 39.6 as the top tax rate for singles over 400,000 and married over 450.
Correct.
Is that a done deal? Is it? I mean, we're asking you to pull out your crystal ball. We know it's very cloudy, but give us your best guess.
My best guess is it won't happen until next year, based on everything that I'm seeing out of Congress. The Republicans, the Democrats do not have the votes based on the Republicans and the moderate Democrats. I think if we'll see something probably in 2022, but given the way things are going right now, I feel I don't see that happening before year end.
And if they do something, let's say in the middle of 2022, will that revert? That'll basically cover entire income of 2022. So we almost need to anticipate some kind of raise at some point next year.
I believe so.
Fair to say.
That's fair to say.
Okay.
So in the top tax bracket currently is 35%, correct?
Correct.
Okay. So 35 to 39.6 potentially, or maybe they come to some type of agreement and settle on 37%.
That would be nice if they did, but
Yep.
And let me show. I'm by the way, as a trusty co-host occasionally on Business RadioX, I'm allowed to ask one very dumb question every show. So this might be it. So the highest tax rate going up to 39.6. What about the other rates? Are they all being potentially going up? Only a couple, just the highest?
So from what I have read to date, the rates up to 28% will not change. But the 32 and the 35% will make some changes between the 350 to the 450,000 mark for married filing joint filers.
Good.
A couple other quick topics. Capital gains rates. Where do you see those potentially going up? And then once you answer that, I'll have a follow-up question for you as well. So
With the capital gains rates, we see them going up to 25% for individuals over, I believe it was $500,000 in total income, $450,000 for married filing joint, and $400,000 for singles. The current proposed is that rates would take effect this year after September 13th, starting September 13th through the
So
end of the year.
retroactive.
So it would be retroactive to today, and anything that was prior to September 13th of 2021 would be under the old rules of a maximum of 20%. And that also takes in if you've got any legal contracts that are in place prior to September 13th, those legal contracts would also follow the 20% rule.
And
as
is
well.
this part of the bill that has yet to be passed? So that's what they're talking about. So that's still alleged, I guess. at
That's
this
still
point.
alleged.
Okay.
That's still waiting to be voted upon.
And if you're thinking it may not happen until next year, I guess it's up for debate whether that would still be retroactive to September. Maybe it's retroactive to January. Who knows?
Who knows?
Yeah.
But if it went through in 2022, more than likely it would be retroactive to January 1st.
And under those 400 and 450,000, that rate would stay the same at 20%.
It would you'd still have your 15 and 20% rates
it.
at that point in time.
Okay.
So one thing that I see some landowners do to defer cap gains on the sale of land is 1031 exchanges. Have you heard anything regarding 1031s and those potentially being done away with?
I've heard talk about them being done away with. My feeling is I don't think they will get that through the negotiation process. It's too big of a benefit to a lot of people and would, in my opinion, would harm the real estate industry in and of itself. Because from the 2018 Tax Act, that was the only thing of the 1031 laws that survived was real estate.
And then one last question before we wrap up here. What, going into year end and doing some year end planning, would you be selling assets now in anticipation of some of these cap gain changes if you're a higher income person, or would you continue doing what you're doing and not trying to get too cute with the tax code?
I think it all depends on your likelihood and also your level of risk tolerance. There are going to be clients that will want to go ahead, I want to go ahead and capitalize and take the gains based on now and roll the dice. Other people that will be, all right, I'm going to roll the dice and just see what happens next year.
I got you.
Cliff, a lot of great information. We've learned a lot in the 20 minutes that you've been here. For those people who actually are looking for a good CPA group to work with, tell everybody how they can get in touch with your group.
Well, you can find us at www.wmbocpagroup.com or our phone number 770-622-9885.
And they can ask for Cliff.
They can ask for Cliff.
But there are many CPAs there that can help them, right?
Yes.
Thank you so much for being here. And Scott, why don't you tell everybody a little bit more about PHELAN Myers Wealth Management Group of Janney, Montgomery, Scott?
Yes. So Kevin Myers, my business partner, is not here today. He's actually in Hilton Head with his family for fall break. But it's me, Scott Phelan, Kevin Myers. We are right there on Sugarloaf Parkway in Duluth. We've got 3 assistants we work with. We'd love to talk to you if we can ever help you. Our phone number there is 678-448-4841. And thank you, Cliff, for coming in today, helping us out. We very much appreciate it. The information's great. And that is a wrap for today on Phelan and Myers 2 for 20.
Any examples provided are hypothetical and do not take into account any specific situations. The hypothetical examples are provided to help illustrate the concepts discussed throughout and do not consider the effect of fees, expenses, or other costs that will affect investing outcomes. Any actual performance results will differ from the hypothetical situations discussed during this program. Please consult a professional to help you evaluate your situation before implementing any of the strategies discussed here. There are no guarantees that any investment or investment strategy will meet its objectives or that an investment can avoid losses. Investment products offered are not insured by the FDIC or any other government agency. They are not deposits or obligations of or guaranteed by the financial institutions where offered. They also involve investment risk, including the possible loss of principal. Past performance is not an indication of future results. This information was prepared from sources believed to be reliable, but it is not guaranteed as to accuracy and is not a complete summary or statement of all available data. The views or opinions expressed in this material are solely those of the host and/or guests and do not necessarily represent those of Janney Montgomery Scott, LLC. The concepts illustrated here have legal, accounting, and tax implications. Neither Janney Montgomery Scott, LLC, nor its financial advisors give tax, legal, or accounting advice. This is Phelan and Myers, 2 for 20 with the Phelan and Myers Wealth Management Group of Janney Montgomery Scott. Janney, a member of FINRA, SIPC, and the New York Stock Exchange, maintains a presence in Duluth with their office at 6340 Sugarloaf Parkway, Suite 130 in Duluth, Georgia. The information provided here is taken from sources which we believe to be reliable, but the accuracy and completeness of such information is not guaranteed by us. This is not an offer to sell or a solicitation of an offer to buy any securities. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. Employees of Janney Montgomery Scott, LLC, or its affiliates may, at times, release written or oral commentary, technical analysis, or trading strategies that differ from the opinions expressed here. Investing may involve market risk, including possible loss of principal. Janney Montgomery Scott, LLC, its affiliates, and its employees are not in the business of providing tax, regulatory, accounting, or legal advice. Any tax-related statements are not intended for and cannot be used or relied upon by any such taxpayer for the purpose of avoiding tax penalties. Any such taxpayer should seek advice based on the taxpayer's particular circumstances from an independent tax advisor. For more information about Janney, please see Janney's Relationship Summary Form, Form CRS, on janney.com/CRS, which details all material facts about the scope and terms of our relationship with you and any potential conflicts of interest. For a full description of Janney's investment advisory products and services, please refer to Janney's Form ADV Part 2, available on Janney's website or by